Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharry. Thanks for tuning in. So, do you have regrets? I think most of us do, right? You can't get very far in life without making a bad decision or a miscalculation or a good old-fashioned mistake. Woulda, coulda, shoulda, as my stepdad was fond of saying. I mean, I have plenty of regrets. I'll give you just one example, an investment regret. Around 2015 or 2016, I received a Bitcoin for payment for a service that I did. And I very quickly sold most of that Bitcoin and bought a used laptop. And at the time, that Bitcoin was worth about $400. Oops. You know, the thing about regrets is that they are totally avoidable. That's why they're regrets. We made a bad decision, a questionable call, a wrong turn. But regrets aren't all bad because we can learn from them and we can avoid making the same mistake twice. So why in the world are we talking about regrets today? Well, you probably know that gold has shot up by about 14.6% this month, and some folks out there may regret not buying gold back on July 31st when it was trading at just $4,045 an ounce. Today we're at over $4,600 an ounce. Or maybe you regret not buying silver back when it was $57.66 back on July 31st. It's now up over 20% on the month, trading today as I started recording the podcast at just below $70 an ounce. And while we're on the subject of regretting not buying gold, I ran across a story the other day about some British regrets that I'm going to share with you here in a moment. And I'm also going to explain exactly why we're seeing this sudden surge in gold and silver. It seems to have broken out of the doldrums it has been in most of this year. Why is that? Well, it's a revival of the debasement trade, and we can thank Treasury Secretary Scott Bessent for this little rally. But before I get into all of that, I do want to just take a moment, thank everybody for listening to the show. I appreciate you tuning in. I appreciate you taking a little time out of your day and spending it with me. And I'm going to ask you to do me a favor. If you would, go to wherever you listen to your podcasts and write us a little review. Give us the 5 stars or the thumbs up or, whatever. Just help us to boost those algorithms. All of that interaction helps boost the show and it will show it to more people. You can also help us out if you would be so kind as to share these episodes on your own social media platforms. Again, it will help grow the show. And, if you're getting something out of it, I assume other people would as well. So if you would help us out that way, I would appreciate it. But really, I just want to always take a moment and thank you guys because, you're the reason I'm doing this. I don't really want to sit here and talk to myself. So I appreciate you giving me an audience so that we can have this show every week. So, British regrets. 1/3 of adults in the UK regret not investing in gold in the past 5 years. And 30% say they regret missing out on silver. So this is according to a research poll that was conducted by the Royal Mint. And, if you think about it, it's easy to understand why they feel this way. Over the last 5 years, the gold price has increased by nearly 150%, while silver has gained almost 200%. So you look back, you missed out on that. Yeah, you might regret it. Meanwhile, only 8% of UK adults kept any of their savings in gold, and only 3% held any silver. And this is pretty typical of Western investors. If you poll investors here in the United States, you'll find a very similar phenomenon. Very few hold gold and silver, which is crazy to me in a world where the government is constantly debasing and devaluing your currency. Gold and silver are your hedge against this persistent monetary inflation. And yet, so many people in the West just are not tuned into gold and silver. It's much different over in Asia, and we've talked about this before. Asian demand, particularly Chinese and Indian demand, have really upheld and driven the gold bull market that we've seen over the last couple of years, with Western investors by and large sitting out. Last year, we really didn't see Western investors jump on the bandwagon until the fall. So just a phenomenon that we have, but apparently at least the Brits are aware of it, and now they regret it. And it's interesting because this polling also reveals that the British are worried about the future of their money, as they should be. 73%, so nearly 3/4, said they were concerned about how global conflicts and economic instability could affect the value of their money. This concern about monetary depreciation is certainly legitimate. However, I kind of think they're missing the culprit, right? It's not this nebulous global conflict or some vague economic instability that's stealing their purchasing power. It's their government running the money printing press. Same reason that we have monetary debasement here in the United States. Governments cannot resist the temptation to print money because printing money allows the government to do more stuff, and that empowers government. So it is incentivized to devalue your money because it benefits the government people. So here's where this story on British regrets goes completely sideways. Brits recognize that their purchasing power is declining. They see that both gold and silver could have shielded them from this monetary debasement. They regret making a bad choice by not investing in gold and silver 5 years ago, but they failed to learn the lesson. Only a quarter of the poll respondents said that they would likely put savings in precious metals over the next 5 years. 60% said they would still choose to keep their money in, get this, a checking account. In the immortal words of Shorzy, so dumb. So I suppose in 5 years, we'll see a Royal Mint poll with the results showing that a bunch of Brits regret not buying gold and silver over the last 5 years, right? Because they didn't learn the lesson. So, okay, yeah, folks missed an opportunity to purchase gold at around $1,800 per ounce 5 years ago. And you missed an opportunity to buy $4,050 gold just a few weeks ago. But the opportunity really is still there right in front of you. Because here's the thing. In 5 years, people will almost certainly look back and yearn for $4,500 or $4,600 gold. That's because monetary debasement will continue in both the UK and the good old US of A, and in the Eurozone and in China and wherever there are governments. All of these countries' central banks have a inflation target. Here in the United States, it's a 2% inflation target. In Britain, it's a 2% inflation target. That's the plan, to devalue your money and rob you of 2% of your purchasing power every single year. Now, may not sound like a lot, but it adds up. Every 5 years, your money loses a little more than 10% of its purchasing power by design. This is the plan. When they talk about fighting inflation, the inflation fight, they're not talking about getting rid of inflation. They're talking about keeping it at a manageable level that you won't get too upset about. But really, you should be upset about it because they are stealing your wealth as a matter of policy. So my point is that gold and silver will almost certainly climb higher over the next 5 years because monetary debasement is more likely to speed up than to slow down. But here's the thing about regrets, right? They're avoidable. We can learn the lesson. We don't have to be like the British and go, well, I wish I'd bought gold, but I'm certainly not going to buy gold now, right? You just have to make the right decision the next time. And when you do make a wrong call, let regret be your teacher. Don't make the same mistake twice. And so, if you're looking at $4,600 gold and you're thinking, man, I missed out on $4,000 gold. Well, in the first place, it could drop again. We could see more corrections, right? We've got the war still going on, and we know that that's creating all kinds of noise in the market. So you may have more dips that are buying opportunities. But even if we never go any lower than whatever it is right now, $4,600, give or take, even if it doesn't ever go down from there, it's going to go up, right? So if you buy now, you're going to benefit in the future. And I think that's a mistake people make. I think a lot of people, we're so short-sighted. We're looking at a day from now, a week from now. And if you buy gold today and the price drops tomorrow, you're going to freak out. This is a long-term game. It's a long-term game where you have to kind of set your plan and go with it and tune out the noise. I'm going to talk about tuning out the noise here in a bit, but I do want to just urge you to take action now. Don't keep putting it off, right? Don't let regret build upon regret. So it's a great opportunity to call Money Metals. 800-800-1865. Talk to a Money Metals precious metals specialist. Let them help you understand and figure out how gold and silver can work in your investment strategy and why virtually any time is a good time to buy if you're looking at the long term and if you understand this phenomenon of planned monetary debasement. Also, you might want to check out our specials right now. Go to moneymetals.com, and at the top of the page, you'll see a bar and you'll see a little flame and it'll say specials. And there are several good specials that we're running right now on both gold and silver. I want to take just a moment and highlight that we have great pricing on $10 Liberty Eagles. These coins are an iconic piece of American history, minted by the U.S. Mint between 1838 and 1907. They're 90% gold and 10% copper. And again, we have great pricing on these collectible coins that also have just the pure metal value being 90% gold. For pricing or to purchase, you can give us a call at 800-800-1865. And don't forget to check out the other specials there on the special page. I can pretty much guarantee you that you will not regret making that call, but you might regret not making it. So last week, I had the privilege of interviewing David Morgan. He's the publisher of the Morgan Report, a really good analyst. And if you're not listening to the Friday Market Wrap podcast that we air every Friday, you're missing out, because every week I interview people like David and other folks in the world of investing and finance and have the opportunity to pick their brain. And it's always a lot of really good information, very educational. So check those out, those interviews, if you have not done that already. But anyway, so I talked to David Morgan, and one of the things that we discussed during the interview was the importance of tuning out the noise. And I think right now some of the loudest noise in the marketplace is the U.S.-Iran war. Now, I'm not saying that it's not significant. It's certainly created all kinds of real-world disruptions, particularly in oil flows, energy, but also in other things. Fertilizer, for instance, has been significantly impacted by the closures in the Strait of Hormuz. So the war matters. It's not that it doesn't matter at all. But as far as the precious metals markets go, I think it's a short-term distraction. And I say this because every time there is good news on the war front, gold and silver spike, right? We get any sense that there might be a path toward peace, that the strait is going to be opened, that there may be some resolution, gold and silver rally. And that tells me something. That tells me that the bulls are alive and well. They're still there under the surface. Maybe they're resting, maybe they're sleeping, but the bulls are there. They're just waiting for this war to resolve so they can start running again. War news kind of keeps a lid on the market, but in the long run, I think it's noise, because the war is going to end, right? We'll have an end to this energy shock, and then the lid will come off, right? And again, we see hints of this every time we get good war news. We see gold rally. So I don't think that what we've seen since the correction at the beginning of the war, this sideways trading, this headwind and this struggle for gold and silver, I don't think this is really the fundamentals of the market. It's being influenced by the noise, by the war headlines. But underneath all of those dynamics that supported gold through last year and into early this year, those things are still in place. We still have the massive levels of debt. We still have all of the economic malinvestments and displacements that were created by the crazy monetary policy of both the pandemic and even going back to the Great Recession. We still have a lot of shakiness in the economy that's eventually going to blow up. That's all still there, right? That's what was driving gold higher. Central bank gold buying, the weaponization of the dollar, all of those things are still in place. But right now, the war is kind of overpowering those fundamentals, but they're still there. And as it turns out, I mean, we may not even need the war to end to cut through all of the noise. The Treasury Department may have done that job for us. So if you listened to the show last week, you know about how the Treasury Department put its big fat thumb on the bond market, trying to push down interest rates at the long end of the curve. The whole thing makes sense if you really just sit and think about it, even on a surface level. You know, the U.S. government is paying billions of dollars every month on interest expense. It is continuing to spend money. It is continuing to run massive deficits that have to be financed with more borrowing. And all of that borrowing is at higher interest rates. So the Treasury Department is desperate to get those rates down. And so Bessent took a shot in the dark and didn't go exactly as planned. In fact, I think the whole thing may have backfired. So Treasury Secretary Scott Bessent's announcement that the Treasury would double its buybacks of long-term treasuries did in fact push yields down for about 1 day. And if we go back and look at the charts, the 30-year Treasury yield closed at 5.31% on Tuesday, August 18th. And during the day, intraday, it hit 5.34%. It was the highest yield since 2007. And then the next day, by the close on Wednesday, after Bessent's announcement that he would double buybacks of these bonds on the long end, the 30-year yield had dipped back to 5.19%. So it shed nearly 20 basis points on that announcement. And then 2 days later, it was back to 5.27%. So instead of stabilizing the bond market and pushing long-term Treasury rates lower, the move appears to have actually juiced the debasement trade. And this is evidenced by the sharp, sudden leap in gold and silver prices. Remember, prices tell us something. Prices are signals. And that's why it's so insidious when government people step in and try to intervene in the marketplace, right? Price ceilings, price floors always cause problems because it messes up these pricing signals. So the fact that gold and silver rallied tells us something. Anyway, the Business Times report that I read reveals kind of the fecklessness of the Treasury Department's move. Quote, U.S. Treasury Secretary Scott Bessent's bid to tame U.S. borrowing costs knocked down long-term yields for barely a day. The more lasting market signal, the dollar weakened while gold and Bitcoin rallied, reinforcing a debasement trade fueled by swelling U.S. deficits and concern over the direction of U.S. economic policy. So in other words, the Treasury Department made a move, and the market interpreted that move very differently than what the Treasury Department intended. The Treasury Department intended to say, hey, you know, we've got this under control. We're going to control our rates. And the market said, ooh, Treasury Department's desperate, and look at this horrible fiscal situation in the United States. Maybe we really do need to quit buying these bonds, right? And, you know, it's interesting because it's not that the Treasury's move was particularly big. Doubling the buybacks from $2 billion to $4 billion is really a drop in the bucket when you consider that the Treasury market is like $35 trillion. But the move sent a powerful message. And again, I don't think it was the message that Bessent wanted to send. Brian London, who is a great analyst, I'll actually be interviewing him next week. He called the move a, quote, sign of desperation. And he said that investors saw, quote, blood in the water. And I'll link to his article in the show notes page. It's worth a read. He explains how this move has juiced the precious metals markets, and he has some pretty good charts to show how the price is now broken out of some very important technical levels. So that'll be over at the show notes on moneymetals.com/news. So I should note that a few days ago, bonds caught a boost and yields dipped again when Bessent hinted that the Treasury could use $1 trillion from the Treasury's general fund to further bond buybacks and lower rates. So he kind of doubled down. Brian London summed it up this way. This too will prove fruitless and temporary because Bessent's attempt to show the Treasury's strength has only served to expose its weakness. Combine the market's response to erase Treasury's flex in bonds with the big move into metals, and I believe we're seeing the first signs that mainstream investors are once again embracing the debasement trade. And he's not alone. I've seen this same messaging in a lot of mainstream analysis over the last few days. I think it's generally understood that what Treasury tried to do did not succeed and that it sent this very different message. Now, I would argue that the debasement trade never really went away. It's kind of been papered over by war news, and I think it's alive and well. We see this in central bank gold buying. Central bank gold buying is really a very strong, visible signal of this debasement trade. Because what's going on there? Well, we're seeing central banks shedding treasuries, getting rid of dollar assets, and buying more gold. They're lowering their exposure to the greenback. They're raising their exposure to real money and gold. Now, keep in mind, the Treasury hasn't even actually started doing the bond buyback. All of this market reaction is based on the announcement, which is pretty typical, right? Markets are forward-looking, so we're looking ahead at the news. So they haven't actually started the mechanism yet. According to the announcement, the expanded buyback operations will begin on September 9th and run through November 4th. So basically, this is going to happen next month. Nevertheless, again, and I can't emphasize this enough, the announcement did not have the impact Bessent hoped for. In fact, it appears to have exacerbated the situation, and again, as London noted, it's reignited the debasement trade. And so what is the debasement trade? I guess I probably should explain what exactly that is. It's an investment strategy that emphasizes holding tangible assets, particularly gold and silver, also other commodities, to protect against the decline of fiat currencies caused by monetary debasement. So to simplify that, to put it in real world terms, we have a global market that's looking at the U.S. They're saying you are levered up to the hilt. You're buried in debt. You can't quit spending money. You're debasing your currency. We don't want to hold this. We want to hold these tangible assets, gold and silver. We want real money. We don't want your paper. So treasuries have been selling off over the last many months because many countries are increasingly wary of holding U.S. debt, right? We know that the national debt eclipsed $40 trillion last week. I talked about it a little bit on the show on Wednesday, and the very next day we saw the news that we were now over $40 trillion in debt. And with U.S. policymaking giving no hint that they intend to address the borrowing and spending, America's fiscal situation doesn't exactly inspire confidence, right? It's like your drunk uncle, he's run all of his credit cards all the way up to the hilt. He's coming to you saying, hey, I need to borrow some more money. Are you going to lend him more money? Probably not, right? He's irresponsible and drunk. And that's basically the U.S. government, at least in terms of its fiscal responsibility. On top of the fiscal problems, on top of the debt, the U.S. has weaponized the dollar as a foreign policy tool, and that has made many countries even warier about holding greenbacks, right? You know, people have seen what the U.S. has done to Russia in terms of economic sanctions. They locked Russia out of the SWIFT system. They've taken all of their dollar assets, and they've even threatened to sell those assets and give the money to Ukraine. Well, if I'm another country and I'm looking at the way the U.S. has handled this and the way the U.S. has used its dollar as a billy club, I'm going to be wary of holding them, right? I don't want the U.S. government coming to me and saying, well, you better do X, Y, or Z, or we're going to take away your access to dollars. So if you're afraid that the dollar rug is going to get pulled out from under you, well, you get the rug out of the living room. And that's what a lot of people are doing. That's the essence of the debasement trade. Then on top of that, you know, the bond market is a mess anyway, and the AI boom is exacerbating Uncle Sam's funding problem because financing for AI expansion is eating into the broader bond market. People are buying these AI bonds. They're lending money for this AI build out because everybody's all AI. It's a little bit like the dot-com bubble. A lot of people out there are saying that eventually the AI bubble will collapse and pop just like the dot-com bubble did. But that's neither here nor there right now, may or may not. But the fact of the matter is, all of that borrowing for AI is flooding the market with debt. And if you have a choice between, lending money to this AI company that you think, well, they're on the cutting edge, they may be making billions in the next few years, or lending money to Uncle Sam who, may be bankrupt next week, what are you going to pick, right? So Bessent tried to frame the bond buyback as a liquidity intervention to maintain market plumbing, right? They like using words like that. It makes you feel like, yeah, it's no big deal. It's technical. You don't even have to, don't look here. This is a technical operation that we money people have under control. But here's the thing. We don't have a plumbing problem, right? The Treasury Department intervention didn't solve the fundamental issue. And that's cleared by the quick rebound in yields after the announcement. Right? Nomura macro strategist Charlie McElligott said the move showed the Treasury Department is reaching its pain threshold for higher yields. And he described the gold up, dollar down move as a, quote, pressure release valve as the U.S. intervened to stabilize long-term rates. Billionaire investor Ray Dalio was even more emphatic, urging investors to cut bond exposure and hold gold, along with some Bitcoin, as protection against a potential U.S. debt crisis. I see the words debt crisis, and that does not seem like any kind of exaggeration to me at all, right? We've talked about the debt black hole. We've talked about the reason we call it the debt black hole. It's so big and powerful. Its gravitational pull is so strong that it is warping and impacting everything in the economy around it. So Dalio's right. We do have a potential debt crisis brewing, and you do want to have exposure to gold, silver, hard assets if that debt crisis precipitates, or I might say when it precipitates. The market's tepid reaction to the Treasury's announcement reveals an ugly reality. Try as he might, Bessent can't control the market, right? Government tries to intervene, and it can intervene successfully, but ultimately the market is too big and powerful. The market will do what the market's going to do. And the government can intervene, and it can move the needle temporarily, but it can't override the underlying market dynamics. As Manulife Investment Manager, Manulife Investment Management Senior Portfolio Manager Nathan Toof told Business Times, quote, "The Treasury can influence liquidity and sentiment, but it can't sustainably override growth, inflation, deficits, and supply." Right? The Treasury can maybe make its own noise and move the market, but the noise can't cover up indefinitely these underlying dynamics that have been driving gold and silver higher for many, many months. So the other problem is that the Treasury Department is pretty limited in its ability to intervene because it can't print money. That means it has to borrow money to fund its bond buybacks. And what I mean by that is to pay off the people that have already loaned Uncle Sam money. Uncle Sam has to borrow money from new people to pay the old people. If that sounds a little bit like a Ponzi scheme, well, you kind of get it, right? In practice, the U.S. Treasury will have to issue more shorter-term bonds and notes to raise cash so it can intervene on the long end of the curve with its buyback program. It's a little bit like rearranging the chairs on the deck of the Titanic. Now, enter the Federal Reserve. Warsh and Company will face increasing pressure to intervene on behalf of the Treasury because through quantitative easing operations, or QE, the Fed can buy bonds using money created out of thin air. The Fed can do money printing. And when the Fed buys those bonds, it holds them on its balance sheet. So that means they are decreasing the total number of bonds out in the marketplace instead of simply shifting supply towards shorter-term notes. So in other words, when Treasury runs its operation, there'll be fewer long-term bonds, but there'll be more short-term. If the Fed runs QE, there's just less bonds because they hold them on the balance sheet. And the reality is the Fed is already running small-scale QE operations right now. Now, you'll never hear anybody at the Fed or in the mainstream media use the term QE. In fact, they'll insist, oh, this isn't QE. They'll say it's plumbing operations. But it is QE. They're running it now, and we can see it as evidenced by the expanding Federal Reserve balance sheet. They are, in fact, buying bonds right now with money created out of thin air. Now, it's important to remember that this newly created money gets injected into the financial system, and this, by definition, is inflation. Historically, the Fed has held interest rates higher to battle inflation, right? That's the whole thing. The Fed's going to have to hold interest rates higher for longer. That's why every bad war headline tends to push gold lower, because the expectation is that this war is creating a lot of price inflation because of the oil shock. Therefore, the Fed will have to keep interest rates higher for longer to battle this inflation. So, in other words, the operation necessary to lower the federal government's borrowing costs creates an effect that necessitates raising its borrowing costs. See what I'm saying? This is why I point out over and over again that the Federal Reserve is in a catch-22. It simultaneously needs to raise interest rates to battle inflation and cut interest rates to deal with this debt black hole, these rising government borrowing costs, and this situation. Now, if you talk to a person at the Fed, they're going to say, oh, no, we don't even consider the government's fiscal situation when we're doing monetary policy. We're independent. That's the Treasury Department's problem. BS. The Fed absolutely works with Treasury. There's no question about it. There is no Fed independence. That's all smoke and mirrors. So the bottom line here is the U.S. government is losing control of the bond market and yields. Investors are no longer just reacting because yields go up, right? Changes in price and yields on bonds isn't the only factor. They're actually reacting to the reasons behind yields going up. That means transparent U.S. intervention isn't going to soothe the market, because the market understands the reason yields are going up is because of the massive levels of debt, the fiscal irresponsibility, the devaluation of the dollar, and the weaponization of the dollar. And this is a huge problem for a country already shelling out over $1 trillion per year to service the debt. And it also is a big problem for you, because when it becomes clear that the Treasury can't control interest rates, the Fed will have to get more aggressive. A more aggressive Fed means looser monetary policy, more quantitative easing, interest rate cuts. That means more inflation, and that means the purchasing power of your money erodes even faster. That's what's going on here. That's the bottom line. We are, many analysts argue, heading into a long-term bear market in bonds, where the supply of debt is too high, the demand for debt is too low, interest rates are too high. On top of that, an inflation problem. And what the Fed will have to do ultimately is intervene, because that's what the Fed does. They talk a lot about battling inflation, but what they actually do is support the economy, support the stock market, support the borrowing and spending. The Federal Reserve is basically the engine driving this out-of-control economic engine. And that, ladies and gentlemen, is why every single week I urge you to get gold and silver, to have real money, to start a plan to protect yourself from this monetary debasement. I'm not saying that you want to sell all of your stocks and, put everything into gold and silver. No. I'm not saying that at all. I very much believe in a balanced portfolio, right? You don't want to put all of your eggs in one basket, but you do want to have real money, and you don't want to try to save in fiat dollars, because in 10 years, that fiat dollar will buy far less than it does today. So call 800-800-1865. Talk to a Money Metals licensed precious metal specialist. Ask them questions. They can help you figure out what products might work best for you, what mix of gold and silver to help you figure out how it fits into your broader investment strategy. These folks are fantastic and knowledgeable. Tap into their brains. Use that resource. If you don't want to talk on the phone, go to moneymetals.com, chat with a precious metals specialist on a chat. That way you don't have to talk to anybody if you don't want to. Or if you want to just buy gold and silver, you can do that directly from the website. You can find the products that you're looking for. You can check out the specials. You can order online. We'll ship the metal directly to you. Or you always have the option of storing your precious metals in our state-of-the-art bullion facility in beautiful Eagle, Idaho, where we run regular audits, unlike the folks at Fort Knox. So do it today, 800-800-1865. So that is a wrap for this episode of the Money Metals Midweek Memo. You can get more information on everything that I've talked about on the show today and a whole lot more over at moneymetals.com/news. And if you want the latest news and information relating to gold and silver right in your inbox, make sure you sign up. Get yourself on our email list. Of course, you can subscribe to the Midweek Memo on your favorite podcasting platform. And when you do, you'll be able to tune into our Market Wrap podcast every Friday that I've already mentioned. You'll get a quick overview of the week in precious metals, along with conversations between yours truly and interesting people from the world of gold and silver, economics and investing. People like Brian London, David Morgan, Greg Weldon, all kinds of people. So check that out. Thank you so much for listening to this show. I hope you have a fantastic rest of your week, and I'll be back again next Wednesday.